The week started on a cautious note as Fed members hinted at more rate hikes in the US, but inflation expectations on the other hand and used car prices fell, pulling the US yields and the US dollar lower just a day before the release of the much important US CPI data. So welcome, this is Swissquote's Daily Market Talk. So the week started on a cautious note as European and US stocks eked out some small gains on Monday, but appetite was limited in the US on news that the new capital requirements for the US banks would be tougher moving forward, and mega cap stocks didn't really give much support to the market yesterday. Tesla, for example, lost up to 2% during the session, while Amazon closed yesterday's trading session more than 2% lower before its Prime Day, which now became an industry-wide shopping day in the US, and which will also give us a hint on how much US consumers are now ready to up their spending online. Meta, on the other hand, advanced 1.23% yesterday as its new platform Threads, which comes as a competition to Twitter, already amassed 100 million users since its launch last week, while internet traffic data from Cloudflare show that Twitter use tanked. Oh well. On the banking front, one of the biggest news of yesterday's trading session was Mr. Michael Barr's speech, where he actually says that he will recommend tougher capital rules for banks with 100 billion US dollars or more in assets, as opposed to 700 billion US dollars or more in assets that were so far concerned with the tougher rules for their capitals. So this simply means that the medium-sized institutions will also be subject to tougher capital requirements, and it's not going to be just the global mega banks like Citigroup and JP Morgan and Goldman Sachs. Now, Barr also said that the risk of contagion implies that we need a greater degree of resilience for these firms, for these banks, than we previously thought, because obviously the risks posed to society are bigger, and that's obviously true, and we saw that all back in March when Silicon Valley Bank collapsed. Now, one thing that was catchy in the speech is also that unrealized losses and gains on security portfolios will be considered when calculating this regulatory proposal. So that's obviously a thing that could have helped avoiding the Silicon Valley Bank's collapse, but that's also a thing that will put a bigger pressure on banks altogether, as they all had to buy tons of treasuries in the past, and now they are sitting on significantly discounting portfolios. Anyway, the good news is that the big banks like JP Morgan and Citigroup didn't really react aggressively to the news. I mean, the investors didn't. And even better news is that the smaller and regional bank stocks also tempered the news quite well as well. PacWest, for example, lost only around 1% yesterday, and Invesco's KBW index even closed the session slightly higher at yesterday's trading session. Now, it doesn't mean that the banks are completely out of the woods at this stage of the game, but the banks are very vulnerable to the changes in their stock prices. I mean, they are so vulnerable, in fact, that a heavy sell-off, if heavy enough, could be fatal to the existence of a bank, as was the case for Silicon Valley Bank in March, remember. So, seeing a mild market reaction, mild investor reaction to the news is rather reassuring. What's less reassuring, however, is the fact that the Federal Reserve will continue pushing the interest rates higher from now on, and that will put an extra pressure on lenders, and the regional banks are unfortunately the most vulnerable to interest rate changes in the US. And in the sense, we had another day of tough Federal Reserve talk yesterday, where both Federal Reserve's Mary Daly and Loretta Masters said more interest rate hikes are needed to bring inflation lower in the US. Raphael Bostic, on the other hand, who is actually known to be a hawkish Federal Reserve member, argued that the FOMC could be patient, and they could be, and see how the US economy responds to the prior monetary policy actions. So the prior action being the most aggressive monetary policy rate hiking of the modern history of central banks. So let's wait and see what happens, right? Other than that, it was a day of digesting and somehow scaling back the recent rise in hawkish Fed expectations, despite the hawkish comments, as used car prices in the US, which have been a good indication for inflation in this inflation cycle, well, fell 4.2% in June, and that was the largest drop since the beginning of the COVID pandemic. Now, the prices came down by more than 10% in a year. Plus, according to the New York Fed's latest survey, well, inflation expectations for the next 12 months in the US fell to 3.8% in June from 4.1% printed a month earlier, although unfortunately the 3-year expectations ticked higher to 3%. Now, the same New York Fed survey also showed that American consumers were more pessimistic about the job market outlook in the US, and the median expected spending growth in the US over the next year actually declined, and it declined to the lowest level since September 2021. Now, it's just a lot of blah blah, a lot of information, a lot of data, but if we summarize all this in a simple manner, well, it means that Americans are a bit more scared for their jobs right now. That could get them to spend a little bit less money in the future, and that could ease inflationary pressures in the US. So all this is music to investors' ears, but the US e-commerce sales are expected to grow by around 116% still on Amazon's Prime Day this year, and obviously strong spending news from the US, from American consumers, is bad news per se for the Federal Reserve's inflation fight and for the rest of the world, which has to follow Federal Reserve in this inflation fight. Anyway, back to the markets. Capital flew into treasuries yesterday. The US 2-year yield, for example, declined about 10 basis points at yesterday's trading session, while the US dollar plunged below a long-term ascending channel base despite the hawkish Federal Reserve expectations and hawkish Fed comments. The US dollar bears are now targeting the 100 level as their next destination. As such, the dollar yen plunged below the 141 level and is preparing to test the 50-day moving average, which stands near the 140 psychological level to the downside. And on a side note, while bank lending in Japan contracted more than analysts expected in the month of June, and we all know that the Bank of Japan will at some point in the foreseeable future start raising its interest rates, which will make long Japanese yen a profitable trade. But again, timing is key. Now, the euro dollar rallied past 110 mark despite a sentiment index that showed a faster deterioration for July in the Eurozone, and today the German CPI will likely confirm a latest rebound in the German inflation, as low price train tickets that the German government had distributed to the people last year are now creating a positive base effect for inflation in Germany. And on the other hand, the ZUE index is expected to warn of worsening mood in Germany as well. Now, higher German inflation is obviously positive for the euro because it leads to hawkish ECB expectations, but I'm not sure that Christine Lagarde or her colleagues at the European Central Bank care much about how people feel about the economy and all these sentiment indices, because people will feel what they feel until inflation eases in the Eurozone. That's all the European Central Bank cares about. Full stop. So, the softening US dollar despite the hawkish Federal Reserve expectations and hawkish European Central Bank expectations could actually support a further rise in the euro dollar toward my 112 medium-term target. Elsewhere, American crude actually remains offered near its 100-day moving average this week, and that's around the $73.5 per barrel level, and support is seen near the 50-day moving average level, which is near the $71 per barrel level this week, while gold sees resistance near the $1930–1935 range. A softer US dollar and a downside correction in US yields could actually help gold pull out these offers and regain the $1950 psychological mark, where stands the 100-day moving average. But for that to happen, the US needs softer inflation, which is well, completely against the idea of gold as being a hedge against inflation. But oh well. This is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful comments and messages. I hope this episode of Market Talk has also been helpful and insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on Twitter, and on LinkedIn for regular market updates. And subscribe, of course, to our YouTube channel for daily market comments. I will meet you again tomorrow, and until then, good day trading.